biggest financial catastrophe in generations began in the US and spread across the world.
This is a once-in-a-half-century, probably once-in-a-century type of event.
It started with so-called subprime mortgages.
But they're a little risky.
High-risk debts that were about to go bad.
How come nobody's talking about this?
Fear of the toxic assets spread like a virus and panic set in.
What is that?
That's America's housing market.
As the GFC, or global financial crisis, escalated, credit dried up.
It's like 10 years of saving is now completely gone, vanished.
Financial institutions collapsed. Global markets tanked. Months earlier, at the start of 2008, the Rudd government was already wargaming disaster scenarios.
What would happen if, for instance, there was a capital strike on the balance of payments against Australia? How would that work through? What would be the consequences? How would you deal with that? We worked through scenarios. What if there was sovereign default? The country went bust.
By September, there were fears of a run on Australian banks. Pradeep Phillip was the Rudd government's policy director.
And I received a call on the Saturday from the CEO of one of the largest second-tier banks in Australia. And he said, I'm ringing you to let you know that our single largest depositor is going to withdraw their funds.
The Australian government guaranteed bank deposits and within days launched its first stimulus package.
This is not a question of choice. This is what we are required to do.
The Reserve Bank slashed rates.
No one wanted a recession on their watch. No one wanted to undercook this. And part of the problem was no one knew exactly how this was going to play out.
Unlike much of the rest of the world, Australia managed to dodge a recession. But 10 years on, many Australians are still getting back on their feet. Mark Weir and his wife have just moved to Hervey Bay in Queensland.
It was something that was actually planned before the global financial crisis. The icy winds of the global financial crisis blew and destroyed our plans and aspirations.
But he's not just unpacking. He's sorting through the paper trail left from his decade-long battle over the collapse of Townsville investment company Storm Financial. Mark Weir had borrowed money to invest with Storm, but as the GFC played out, the company went under.
When it became apparent that we'd virtually lost everything in our security in retirement, it was unbelievable. The trauma was unbelievable.
The Weirs lost more than $2 million they'd worked a lifetime to save and found themselves owing $500,000 more. 2 weeks ago, Mark Weir finally received a small settlement payout.
I'll be quite happy if I don't have to engage with a lawyer or a bank for the rest of my life either. And I think that's a pretty general attitude amongst Storm investors. They will not trust the banks.
Trust was in short supply across the financial system.
It was very disorientating, very scary. Everyone's time horizon collapsed. No one dared to trust anything for more than a few minutes.
Financial journalist and author Gillian Tett is one of very few people who predicted the crisis.
When I started warning people about some of the dangers building up there, either people outside the industry were completely uninterested. I mean, it seemed to be such a geeky, boring world that no one cared, or the people inside the industry, who for the most part were getting rich from it, were pretty unhappy that I was saying these things. And so one of the problems was that the bubble kept growing bigger and bigger and bigger, but almost nobody who was in a position to stop it would talk about it or actually blow the whistle.
She says some lessons have been learned.
Everyone knows that if you slice and dice debt in a really extreme way, you can build new risks into the system. And people always also recognize that if you tell bankers that they will get paid a proportion of the money they generate for the company, you create an incentive for them to basically go to crazy extreme lengths to drum up business.
It's almost impossible to quantify the losses caused by the GFC. In the US alone, the cost to GDP is estimated at more than $13 trillion US. To help the global economy recover, trillions more were pumped into the system, and the effects of that are still playing out on global markets. Nick Ferrers was managing $25 billion for the British insurance company Prudential when the GFC hit global markets.
It was terrifying. We genuinely believed at the time that there was a solvency issue in the banking sector, and we were certainly concerned about in the absence of the intervention that we saw from both the Federal Reserve and the authorities in the US, there was a genuine risk that the banking system would have been insolvent.
He says it's possible it could all happen again, even within a matter of months, in part because companies have again built up massive debts.
US corporate debt to GDP is now higher than where it was in 2007 and higher than where it was in 2000. And we think that that's one of the biggest risks to the global asset markets.
Memories are short. We're already starting to see some of the crazier practices of the world before the great financial crisis creep back into the system. And we've also seen a lot of activity go out of the regulated banks into the unregulated non-bank sector. And that's pretty alarming. But no one can ignore the fact that debt in China as a proportion of GDP has doubled to about 300% in the last few years. And that's a pretty scary number.
How that will play out is anyone's guess.
One of the lessons we've learned is that it translates to the real economy really quickly. It's intensely personal. People lose their jobs. They lose their confidence. They lose their assets. People lose their life savings. They get sick. There's a lot of stress and mental health. Family breakdown occurs. Trouble like this, catastrophes like this, actually play out quite quickly into the real economy. Because after all, that's what the economy is about. It's about people.